Welcome back to Dukascopy TV. Joining me to discuss the impact the Fed's decision has had on savers' returns and the US economy in general is Mourtaza Asad Syed from Société Generale. Thank you for joining me, Mourtaza. So Mourtaza, can you tell me, how do you think the Fed's decision will help refuel the economy in the way that they have decided to keep interest rates low until 2015? Do you think this will help reduce unemployment?
I don't think it will help reduce unemployment right now. I think it needed to have low interest rates to have unemployment rate go up. In fact, they made two decisions. The first one is to commit to very low interest rates until 2015, and the second one is to buy mortgage bonds, the MBS. And this is really to help the real estate market, the housing market, the construction market, and then the US economy by the sector of the construction, which is very labor intensive and also enables people to move out of the state to find jobs in other states. So this is really to liquefy and to bring liquidity to the real economy, instead of just bringing liquidity to the market and Wall Street. Bernanke mentioned that he was really interested in promoting Main Street. I think it will take some time. I think effect will not be immediate. It won't be huge. QE is very debated. Impact of QE will be very hard to assess, even the years to come. Our feeling is that QE is a prerequisite. So without QE, situation would be much worse. QE is just enough for a jobless rate to decline a little bit. It will not accelerate. We might need something else really to build up and to pump up the economy.
What strategies do you think the US could come up with to increase growth and to encourage employment?
I think that's a very hard question. I think that's the real question for everyone. One obvious answer, which takes time, is a long-term strategy based on education, trying to improve the educational system and the educational background of average Americans, especially in technical jobs. There is a mismatch in the job market between the new jobs and the people unemployed. So this mismatch can be corrected with education, but this is really a long-term trend. On the productivity side, productivity has increased a lot in the US, so it's not there where there is big level of improvement, but we see buckets of growth potential in the US, especially in the real estate market, the construction market, where in the next 5 years there is a lot of house to be built, or at least multifamily buildings, residential buildings. The other segment could be surprising in auto. Automotive the average age of a car in the US is very old, it's about 11 years old. So America needs to renew their car inventories, maybe less cars per capita, but at least newer cars. And of course, when we talk about cars or housing, we talk about energy efficiency. And this is really where the US has a technological advantage and a home market advantage. They have a big domestic market. So the growth potential, growth strategy could really be on this energy sector, energy efficient changes led by the US.
The Fed's decision has a negative impact on savers' returns, so what should they be doing?
That's the interesting question, because right now we can debate about the economic impact, which is very uncertain. What is certain right now is that interest rates are low and they're going to remain low. So it means that for investors, savers, the impact is right now right on their account. Deposits account are going to pay nothing for the next 2 years at least. And inflation is still there, not very high, quite moderate, but about 2% a year. It really erodes your capital. So this is where really individuals and investors have to do their homework. What we think is, of course, equity market has been supported by those pro-economic, pro-cyclical measures. But when you allocate from cash, you allocate first to something that is quite secure and still quite liquid. So short-term bonds is for us something attractive. Also currencies where there is some carry, emerging markets, currency pay on average 5% interest rates, when OECD pay about 0.3% interest rate. So this carry trade can be done at the margin in terms of a cash allocation. About 5 to 15% of one's cash could go in those emerging market currency, where the interest rate at least can compound with the appreciation of those currencies. But really the bulk of the money, which is not immediately needed in those depository accounts, could be placed in credit, 2 to 3 to 5 years bonds from large companies, large corporates that have issued a lot of bonds right now. It provides a very liquid market and very sensible alternative to cash deposit accounts.
Well, thanks so much for those great insights, and thank you so much for joining me today, Mourtaza.
Thank you.
Well, that's all we've got time for right now, but stay tuned to Dukascopy TV for more updates and interviews. For now though, goodbye.